Hello, everyone, and welcome to this live training today. We're covering financial modeling with AI. Very excited to be here. My name is Christian Wattig. And before we dive in, I'd love to hear a bit more about you. So can you find the chat button and type in, where are you located and what's your role at work? I'd love to see a bit more about who we have here today. So go find the chat button and type, where are you located and what's your role? Hi, Chris from Omaha. Another Chris from Utah. Hi, Sandra from London. Layam. Karen Willem from Netherlands. Fantastic. Jesus from Austin. Kevin from LA. Felicia from Illinois, I assume. People joining from Paris, from Chicago, from South Africa. Fantastic. So I'm located in New York City. And then if we can get the slide going, that I can introduce myself real quick before we dive in. So I've been in FP&A leadership roles for over a decade, first in consumer goods at Procter & Gamble and Unilever, and then also in tech at Squarespace and Datarails. And but for the last 4 years, I'm going after my passion, which is teaching, and I hope that also comes across today. Now I'm a corporate trainer, and I created the FP&A certificate program for the Wharton School. It's an 8-week program that we run 3 times a year. And yeah, I love going to companies and doing training sessions there for them. But let's actually dive into the topic. Enough about me. So model planning, right? Before you even open up your spreadsheet, before you even start building a financial model, it's important to think, what kind of a model do I even want to build? Because it's not one size fits all, right? At the bottom of the screen here, I put 4 common ways to evaluate an investment decision, right? That's what we'll talk about first. Because the 2 use cases for modeling in FP&A are either, is an investment viable, right? We want to model that out, or to make projections. We'll cover both. We'll start with investment decisions. And there, it's crucial that you have a good fit between your business case and your financial model. You can't just use one financial model for anything you want to model, for 2 reasons. One, and we will see that in a minute when we dive deeper into the different model types, if you use the wrong model type, the recommendation, the output just won't be of high enough quality. And there are different reasons for that. I'll talk about it in a moment. But the second reason for why this fit matters is also crucial, and that's when you've done your financial model as a finance leader, your job isn't done, right? Because the next step then is to essentially sell it. Because if you're just write in Excel, you're not really moving the needle. You need to convince leaders across the company that it's worth it to go ahead and implement whatever your model points to, right? And there, you need to make sure that the complexity of the model matches the business case. What I mean with that is, you don't always want to throw the most complex model type at your cross-functional business partners, because the risk is that if they don't understand how you're arriving at your recommendation, if it's a black box to them, then they're less likely to actually go with it, right? To actually support you in implementing the recommendation. And so let's actually start with ROI and payback. They're a bit of some of the more easier financial model types. But I want to ask you this: how does ROI work? Please type it in the chat. You will see that this is not your usual, webinar where you lean back and someone talks at you for an hour. We'll do a few of these chat prompts because I would actually like you to pause and think about these things. So I'm sure Some of you have come across ROI before. I see a lot of you have good amount of experience in finance. So how does ROI work in a nutshell? Type it in the chat. What does ROI do? And by the way, if any questions come up as we go through this, please do put them into the Q&A box, because we reserve time to cover questions at the end. But for now, I'm curious what you think. How does ROI work? I'll give you a moment to think about it. A lot of shy people. Yeah, that's okay. I'll help you there. Maybe the next question is a better fit. So in its simplest form, ROI is calculated by dividing revenues from the cost of the investment, right? And then you get a ratio. And if that ratio is higher than 1, you move forward. Alternatively, you could look at the net revenue of the net returns of the investment, so the profit essentially, compared it to the cost of the investment, and then you want a ratio that's higher than 0. And I'm seeing some answers actually come in. Maybe there's a bit of a delay we're dealing with here. So it helps to compare options. Yes, Raoul says they quantify the value as a result of the investment, evaluate financial viability. Yep. Increase in net profit over a period of time divided by the value of the investment. Thank you, Adam. You nailed it, right? And so then when you calculate your ROI, so let me ask you this. It's one of the most popular methods for evaluating an investment decision out there. Why is it? It's a bit of a simpler question. Why is it that this method is so popular? Give you a moment. Thank you, Tanner. It's simple. Thank you, Adam. Exactly. It's simple. It's one of the simplest methods out there. You don't need a degree in finance to understand that when your revenue is higher than the cost of your investment, the thing that you're looking at might make sense, right? And then we have payback. So payback is closely related to ROI. And essentially what it does is it shows you how long does it take until I get my money back, right? One way to calculate it is 12 divided by the ROI, and it gives you the number of months until you have earned your money back. Even easier to understand an ROI in some sense, right? Because, everyone gets that. But there's more that payback can do. So in addition to evaluating an investment opportunity, what can payback be used for? Any ideas? This is a bit more of a difficult question. So if you don't know, that's fine. But I'm curious to see if anyone knows what else companies use payback for other than just figuring out how long it takes until we make back our initial investment. Prioritization, says Tracy. Rodrigo says prioritize. Mark will talk about IRR in a minute. Comparing projects, break even, comparison. Yeah, so you can use it to compare projects. We'll talk about risk in a minute separately, but you can also use ROI to compare projects. But another use case, exactly, Arthur, it has to do with CAC, customer acquisition costs. Fantastic. I see we have some experts here. So companies look at how long does it take to get my money back, and then they use that for target setting in terms of how much they should be spending in marketing. Because the thing is, you don't necessarily want to minimize your payback all the time. You don't necessarily want to shoot for investments that only have 1 to 3 months of a payback period, because if you're doing that, you're likely underinvesting in growth opportunities that take longer to materialize, right? So as a benchmark, for example, a lot of growing software companies use 1 year of payback roughly as a benchmark. And if they're way below that, then maybe that means that they should be investing into activities like investing into brand awareness, right? Which can take a longer time to result in improvements in revenue. But that's a good way to steer it, is use payback for that. Fantastic. But what's the challenge with our ROI and payback modeling in practice? Because the thing is, if you've done ROI and payback before, it seems simple on paper, right? You just get, you collect, you estimate the revenues, you estimate the investments, and then later on you track it, right? You get the actual revenues, the actual investments. Seems simple. But what makes this difficult in practice? If you've done this, attempted this before, you may have ran into this. Arthur says messy data, bad accounting, not good ranking, and lumpy data. Okay, that of course could always be an issue, but I want to see if there are other thoughts as well. What else? It's based on a forecast, time value. No, we'll talk about time value of money in a moment. No, actually, the thing is that attribution can be a challenge, right? So, for example, how much has our new TV campaign impacted last quarter's revenue growth, right? Because the thing is, most companies do several things in parallel to market their product, right? You may already have social media marketing. Maybe you even have billboards somewhere at the airport or in the subway or somewhere, right? And now you're trying to launch a new TV campaign. How do you know how much of the revenue that you're generating can be attributed to the TV campaign? Because without that attribution, you can't do ROI or payback, right? And so I ran into this a lot when I worked at Unilever. I partnered with the marketing team and we were trying to figure out, okay, how well are our marketing initiatives actually performing? And it turned out to be more difficult than I thought. But what we realized is there's 4 ways you can approach this. You can partner with experts, right? You can buy a marketing mix model from companies like Nielsen, Kantar, or Ipsos. They gladly sell that to you. You can build that attribution model yourself by using data scientists. When I was at Squarespace, we had 8 data scientists on staff, and they built a super complicated attribution model that tried with a lot of statistics to figure out how much did that Super Bowl commercial do compared to everything else we were doing. But then you can also just do it very simple, choose a last touch attribution model where you just say, well, whatever someone saw before they bought our thing, that's what we attribute this to. Or you can run experiments. So it's called difference in difference analysis, where you compare, different approaches. Long story short, what I realized is that this is an art and a science. You can't get it. You will never get it perfect, because sometimes even when you ask people, they don't know what they saw, why they bought a certain product. So sometimes it's easier to go with. So I would actually suggest it's easier to go with something that's not as complicated. Okay. Now, when is ROI and payback, when is that insufficient? When does that not work anymore? When should you use something else to evaluate your investment decisions in your financial model? I'll help you there because it was actually mentioned before in the chat. When the time horizon is bigger than 1 year, then you should not use ROI. Why? Because then the time value of money is irrelevant. What's the time value of money? Well, if someone gives you $1,000 today, that's worth more to you than $1,000 you get in a year from now. Why? Because the $1,000 you get today, you could invest that in the stock market, you could invest that into another project, and then in a year from now, it might be $1,200, right? You don't have that opportunity if you get it in a year. So we have to model the opportunity cost. And that's what NPV does. So NPV stands for net present value. It's part of discounted cash flow models. And when I work, especially with smaller companies, it's often underutilized, right? It's not just something that big companies should be using or banks should be using, or, whenever your time horizon where you collect the cash flows is longer than a year, you should consider NPV, because it takes the time value of money into account by discounting future cash flows. So I'm not going to go into math. The math doesn't really matter. What's important is that it's essentially like the opposite of an interest rate, right? It's a discount rate that you apply to future cash flows so that the later cash flows happen, the more they get discounted to a present value. And then when you have an NPV of 0, it means that the present value of your investments equals the present value of the returns that they generate. What's really important from a practitioner point of view is what happens if NPV is 0? Do you recommend to go forward with that? What do you think? NPV of 0 means that investments equal the present value of future cash flows. If you open a textbook, right, if you take a university course in finance, they will tell you you are indifferent when NPV is 0. But in practice, is that really the case? Maybe a compliance requirement. Yeah, what is compliance? Compliance is something that you have to do where it's difficult to quantify the value, right? And there may be other components of your investment that are difficult to quantify that you couldn't include in the model. So for example, it could be security, it could be something that you hope will retain your employees, something related to a vision that's far out. Strategic values, thank you, Tanner. Those can be difficult to quantify. And so companies do projects that have 0 NPV, sometimes even negative NPV for those reasons. But the other crucial point to consider is how you're dealing with risk. Because any investment, any project that you do, whether it's launching a new product or entering a new market, there are unknown unknowns, right? There are risks that you can't foresee, but they're still there. And you should account for them in your project. So the way you account for them is you put in buffers, right? You estimate your revenues, and then you say, okay, let's just do a haircut 10% because probably it might come in lower, right? You estimate your expenses, you put in a buffer for cost overruns. And you should do that, because if you don't put any buffers, then essentially what you're projecting is 0 unknown risks, which in most projects, it's not realistic, right? So you need to include them. And if you feel like you are really leaning conservative, then an NPV of 0 actually can make sense. Okay. Now, an important term, just important for you to have heard, is the weighted average cost of debt and equity. That's a discount rate, right? Essentially what it is the expectation of your equity and debt holders in terms of what the minimum performance of the company should be, right? Or put differently, your alternative investment, right? If I give you $1,000 today, the expectation is that it will increase in value according to your weighted average cost of debt and equity. Now, for private companies, it can be very difficult to estimate the value of your equity. And what I recommend there is take a look at your past investments that are on average, and look at what was your rate of return. Add a bit of a stretch to that, and that's a good starting point for WACC if you don't know the value of your equity. Now, I want to show you really quickly what that looks like, just so you have seen it, because I'm not teaching the math behind it, because we all have access to spreadsheets and they can do this really easily for you. You would use the NPV formula, you specify the discount rate, so your weighted average cost of capital or the estimate, and you select the future cash flows and you add the investment to it. That's it. Super straightforward, but that's how you calculate NPV. Then we have IRR. So IRR is the internal rate of return, and it usually gets calculated together with NPV. It's a discount rate where the NPV is 0, right? That's a textbook definition. But essentially what it is the economic return expressed as a percentage, right, of your project. Now, why does this matter? Why do you need IRR to determine the attractiveness of an investment if you already have NPV? Let me show you a concrete example. Consider 2 investments. Option A, you launch a product in the current market. You spend $1 million, your NPV is 60,000, your internal rate of return is 12%. Option B is you launch a new product in a new market abroad. So that's the difference. Your investment is a bit higher, 1.1 million, but your NPV is higher at 80,000 and your IRR is higher as well at 14%. Now, type in the chat. A, if you think we should go with option A, B, if you think we should go with option B, or type not applicable because there's missing information. So option A, option B, missing information. Which one would you go with if you're presented with this? Okay, I'm seeing some B's. Also seeing missing information. Yeah, the assumed capital is available. That's fair. Okay, I'm seeing a lot of B. Actually, the correct answer is missing information. Because there's a difference between option A and B here that is not expressed really in the numbers I gave you. And the difference, as exactly Jared, is risk, right? It's a lot more risky to launch a new product in a new market that you don't yet know, right? Launching a product in the current market that you've maybe done business in for years, maybe decades, it has a lower risk. And so, and as a company, you would want projects where you take more risk, you want a higher return, right? Economics 101, the more risk, the more return you want. How do companies deal with that? Well, they use hurdle rates. So a hurdle rate is essentially a target IRR rate that's set by leadership, that doesn't change, that's used to make, so the idea of that is that hurdle rates make projects that have different risk profiles comparable, because you may only have capital to do one of them. I'll answer your question in a second, Chris. So in this case, we say option B has a higher hurdle rate because we want projects where we go into a new market that are more risky, we want more return there. And since our IRR 14% is lower than the 20% target hurdle rate, we don't do the project. Option A, we only need 10% hurdle rate because it has a lower risk. And so since our IRR beats that, we will go with that project. Now, Chris, to answer your question, mathematically, it wouldn't make a difference if you use the discount, if you use a higher discount rate for option B, right? It would result in the same thing. But from a practitioner point of view, actually, the recommendation is to keep your discount rate the same for all projects, because that should be tied to your weighted average cost of capital, to some sort of minimum target return that every project should have. And that's a whole nother decision to change that, to increase that. And it makes it easier to it's just more transparent. If you keep your discount rate the same, but then use different hurdle rates for different projects, makes it easier to talk about. And at Unilever, for example, the way I have it on the slide here, that's how they've been doing for decades to evaluate all their investments. All right. Now, let's talk about the how, right? How do you build these models before we talk about AI, right? Let's first, because the thing with AI is You need to understand how to build the model so you can recognize what good looks like, right? And so let me ask you this. What makes a financial model in Excel effective? What makes an effective financial model in Excel? What separates a model that is built well? Dynamic, thank you, Tanner. Flexible. It's live, yep. A connected three-statement model, yep. Adaptability, accurate. Assumptions in a separate tab, okay. Dynamic with drivers, traceability, and clean. Thank you, Samba. Simple to follow for a user. Thank you, David. So I would summarize it. Thank you, KS. I would summarize it this way. First, it needs to be tailored to the business case, right? We talked already about that. You shouldn't use, NPV models can sometimes be a bit more difficult to follow for cross-functional partners because you have to explain discount rates and hurdle rates and all that. Sometimes an ROI or simple model like a payback works best. But then you need to make sure you have a small surface area for mistakes because everyone makes mistakes in Excel, right? That's just the nature of it. But if you build your model in a way that it's auditable and it's easy to spot those mistakes, then that's the way to do it. And I'll show you in a minute, how to do that. And it needs to be optimized for fast sensitivity analysis because the thing is, a lot of people can build a complex model, but if you get a question in a meeting like, oh, I just learned that the logistics costs increased by 10%. Is the NPV still positive? Does this still make sense? It shouldn't take you an hour to answer that, right? And you can build your financial model in a way that you can confidently run these sensitivities quickly, maybe even live in a meeting. And so let's talk about the how, right? That's what we're trying to do. And of course, everything you mentioned in the chat makes sense as well. How do you do that? Well, I researched this, and there are some fantastic standards out there, right? If you want to go deeper into this, you can look at the FAST modeling standard, the ICAEW financial modeling code. So ICAEW is a British accounting body, but they released a fantastic financial modeling guide. And PwC, the Big Four auditor, also released their global financial modeling standards. Now, I went through all of them, and I combined them to really distill it down to what matters most for FP&A. And so let me actually go to show you this. So when it comes to looking at how do you build your model, you want to look at workbook design, worksheet design, formulas, and quality control. So from a workbook design point of view, you want to have separate sheets for guide, inputs, calculation, presentation, and control. I'll show you that in a second. This is crucial because if you have all your assumptions in one place, it's much easier to quickly run sensitivities, to update it. Also, if you ever have to give this to a colleague, it's much easier for them to navigate this. Should use clear and concise names for each worksheet. Color code the worksheets, have prefixes, calculate only once, because if you calculate the same thing twice, it just invites making mistakes, right? Specify and use consistent sign conventions and follow a consistent formatting convention. So let me show you this with an example model. So here, those yellow tabs in the bottom, they start with I for input, and that's where all of the inputs live, right? Whenever you need to make any changes to the model, you can do it in these sheets. You don't ever have to touch the other sheets. They're just calculations. So all the hard-coded values are here. I have input cells that are highlighted in a specific color so you can find them quickly. Everything is labeled. Then I have a presentation sheet where I have some graphs that I can show. Then I have a bunch of calculation sheets. And these calculation sheets have no constants in there, no inputs. They all come from this other sheet. Then when it comes to worksheet design, you want to make sure that each column has a single and consistent purpose. You want to have all calculations and outputs clearly labeled. I touched on that. There should be a logic in terms of how calculations flow, so it's easier to navigate for people. You want to display time periods horizontally. Timeline should be consistent. I'll show you an example of what I mean with that in a minute. You don't want to interrupt formula consistency by including subtotals. Don't hide sheets, because that's how you can trip people up, right? If they have to use your model, or maybe you forget after a few months that you hit some columns or rows. You want to include definitions. Don't put the $ everywhere, right? Freeze top rows. Input sheets should be self-documenting and enter each input only once. So going back here, if you look at this column, for example, it's for the model period ending February 28th, and it's the purpose of this is the same all the way to the bottom, right? That's the consistency. The more consistent your model is, the easier it is to review. Same with the rows, right? You have the rows across. There are no subtitles here. I sometimes see financial models where I have here Q1, right, in the timeline, and then you have the formula for Q1. That creates issues, because then you have a different formula here than the other columns and becomes harder to review. If you must put the quarters there, put them at the end. This is for calculation sheets, right? Presentation sheets, different story. Presentation sheets are meant to be shared, and there it's fine. You don't need to have the same formula consistency, but for calculation sheets, you do need that, absolutely. Then, maybe the most important thing is formulas, right? Because that's where a lot of the issues occur. So you want to use a unique formula per row that is copied across. You want to keep formulas as simple as possible. So I like the rule of thumb. The rule of thumb is you take your thumb, you hold it to the screen, you hold it next to your formula bar, and if the formula is longer than your thumb, it's too complicated, right? Then you need to simplify it or break it up into multiple steps. Split complex calculations into multiple steps. I'll show you an example. Do not embed constants. Don't leave calculations set to manual. Reference nearby cells. So this is also very underutilized, but makes a big difference for reviewing. I'll show you an example in a minute. And resolve formula errors in presentation sheets, but you may want to leave them in calculation sheets. So let me show you an example of what I mean. So if we go to the revenue sheet here, and we look at the forecast, it's a very simple, actually, let's take this one here. It's a very simple calculation. We reference the sales price and the unit sales rate. And here's even better. So we multiply the unit sold times the unit sales rate. Now, I'm actually already calculating unit sold rate in row 77, right? A lot higher. But I'm linking to it again, and I'm referencing it because I want to keep this formula auditable. I want to, when I press F2, when I click on the formula, I want to make sure that this is all on the same screen, because it needs to be as easy and fast as possible to review. And then lastly, we have quality control. So quality control means you build in checks near corresponding calculations. You link to checks in a master control sheet. And that way you have everything in one place. You can even put alerts and show the errors in every sheet. So let me show you what that looks like. So here I have an error check built in that are linked to the control sheet. So the control sheet checks, does the balance sheet balance? Does the income statement reconcile? Does the cash flow statement reconcile? And if this is wrong, then this returns a 1. And if there's a 1 anywhere here, this master check becomes red. And then you'll see that on each sheet, I have this. So that means no matter where you're modeling, where you are in the sheet, you're always alerted when there is an error. Okay. Okay. So that was a quick tour of the modeling standards. Now I want to talk about AI, because the thing is, AI can be of huge help with modeling. And specifically, I want to talk about how to use AI for helping you with making projections. So let me show you an example of a really cool use case. So I use Claude here, and I said, I need to create an ARIMA forecast for sales. So imagine I have a file that has monthly sales data for a few years. In this case, I have 2018 to 2026, and I have the sales data here. Now, I want to use AI to help me project this out, right? To project this out, I have it until April 2026. I want AI to build me the forecast May to December 2026 based on historical data. An ARIMA model is a certain statistical model. It stands for autoregressive integrated moving average. And it's a statistical model that is especially good at identifying trends. And AI can do that for you. You don't need to have any data scientists on staff. You can use this just like that. And I'll show you how. So a very simple prompt. The prompt is, I need to create an ARIMA forecast for sales. Column B is attached. Write the Python code that I can paste into Excel using the insert Python function. Include confidence intervals. So that's basically saying, with an 80% chance, from where to where do you think this will land? With a 95% chance, what's the best case and worst case? And then double check that the Python code actually runs. So why am I doing this? I'm using Python for two reasons. One, then I don't have the LLM guess, right? Because LLMs are probabilistics, they can make mistakes, they can hallucinate. But if I run a Python code in Excel, I'm not using the LLM to do the projection, right? I use a much simpler way, which is just these Python libraries. Has nothing to do with generative AI. And the other reason is, you could even, if your company doesn't give you access to secure AI where you can upload this, you can just upload dummy data here. You can change the data and then run the Python code locally in Excel. And then you don't need to upload anything to AI. So let me show you exactly how this works. So I'm using Claude here, right? But this works with Copilot, works with ChatGPT, works with Gemini. Just please make sure that you're using the more advanced models, right? Use ChatGPT 5.5 in thinking mode, use Claude Opus, use Gemini in its more advanced thinking mode. By default, it might be set to something like Sonnet in Claude, or fast answers in ChatGPT. Don't use that, right? The AI companies want you to use the cheaper models, but use the better models, and then it matters less for something like that, whether it's Copilot or ChatGPT or Gemini. So I ran this, and it gave me Python code. Now, I could spend time reading this and really understanding what does it do, how does it work, but you don't have to, because you can just test it, right, and see if it runs. So I copy this, then I go to Excel, and so if I'm on the home ribbon, I go to Formulas, and then there's an Insert Python button. If you don't see this Insert Python button, it means you're not on the latest version of Excel. This Microsoft released this last year, and if you have Office 365, you have it. If not, then you need to update your Excel version. So I click on Insert Python, I click on a cell, and then I just paste the code that AI gave me, the Python code, and I say Control and Return or Command and Return on Mac. Then it does its magic. It doesn't send anything anywhere. It doesn't, use generative AI to do this. It uses Python and Excel to do it. Now it says data frame. That doesn't really do anything yet, but if you go up here where you have this drop-down menu, you change it to Excel value, voila, you have the forecast. So now I have May through December. I have the forecast. I have the lower 95% boundary, lower 80, upper 95%. Now, you may be thinking, how do I know that this is accurate, right? How do I know if I can trust this if I don't know how it came up with it, right? If I don't understand any of this, all of this gibberish here, the Python code. There is a really cool way of how you can feel more secure whether this kind of AI forecast works for you. And that's called backtesting. So what I would do here is I would say, okay, I already have the actuals here for let's say, May of 2025 to April of 2026. How about I delete those, start a new chat in AI, upload this, say, hey, forecast May 2025 to April 2026 for me. That's called backtesting, right? You run it on data you already have. And then AI gives you numbers, and you can take those numbers, you can paste them next to the actual numbers that you have, and you can see, okay, how does it compare, right? How would AI have done in the past, given the data set you have? And if you're happy with the accuracy that AI had, then you can likely use the model going forward. All right. So let's bring it back to here. We talked about how you can upload your data to AI, how you can use it. You use Python code to create a projection for your numbers. Very easy, no data scientists required. But what's even better than uploading your data is if you could connect AI directly to your ERP system. That's way better, because then it just has the data. You can speak to it. You can do a lot more with it. And that's where actually I would like to welcome Sebastian to the stage. So Sebastian is leading the solutions team at Aleph. And Sebastian, I'm really curious to see how modern FP&A tools like Aleph address this and bring AI into the mix.
Sure, Kristen. Great to be here, and great to see all the engagement we're getting from the chat. I'm, as Kristen mentioned, head of solutions at Aleph. So first, let me mention a bit about what Aleph is. Aleph is the AI-first FP&A tool that allows finance teams to spend significantly less time on the repetitive, low-value ad tasks every month, so they can dedicate quality time to the high-value strategic planning work that finance is meant to drive, like the very modeling and scenario projections that Kristen just described, right? Aleph accomplishes this by centralizing your data from over 100 disparate sources, applying transformations to clean and enhance it, and then making that data available across all the surfaces where your finance team already works, right? So we have data connectors, like Christian was just mentioning, to your ERP, to your HRIS, CRM, data warehouse, and many other tools. Have an intermediate data layer that transforms that data in deterministic ways so that you can trust those transformations and have the same result every time. And then finally, make it available to interact with in Excel models, in the messaging app of choice, or in web app dashboards, or multiple surfaces. So if you let me present this for a second, I'll go into a quick demo and show how this is done, right? So this is an instance of Aleph. It all starts with integrations where we connect to many of these systems of record. We bring this data in automatically on a daily basis, but you can also refresh manually if you choose to do so. And whenever you connect to an integration, we auto-populate and automatically build a set of tables that come from that integration. So in this example, we're working with a NetSuite integration, and we're seeing all these tables automatically flow in with your balance sheet, cash flow, income statement, AR, AP data, right? So what does Aleph do with this then? It makes it available, as we mentioned before, to interact with on many different surfaces. So if you let me show a quick example in Excel, right? We can very easily open the Aleph add-in here, and you can see it allows you to interact with all of your data in a very familiar interface for all of you who have been building pivot tables on a workbook, right? We can choose which table we want to draw from, select which dimensions we want to see. So let's say account type, account parent, and account. Let's choose a couple months as the columns, filter for this year, do pull. And this very quickly populates all of my actuals directly from my ERP into this Excel spreadsheet, right? If I do show subtotals, format as financials, this starts to look even more like a financial report, right? So why is this connection between the cloud data warehouse and Excel so relevant? Well, as you all know, Kristen was just showing how Claude works with Excel, and I think Aleph can leverage all of this to kind of allow you to get the most value out of this AI tool. A very quick example I was just playing with before going into this is you can also use Claude to bring in all this data that lives in Aleph, right? So for example, I gave it a very quick prompt to use the data in one of the workspaces in Aleph and use the Aleph function that works exactly like a SUMIFS to kind of bring the data in the most up-to-date way into this exact cell, right? So Claude knows how to use this Aleph function, knows how to populate all of the values into a cell, into this tab, and you can have all of your actuals seamlessly flowing in here without having to have backup tabs that contain all the raw data for you to do, SUMIFS or the index matches on, right? So in short, I would say Aleph allows you to basically leverage all this power that Claude is unleashing into this spreadsheets surface. So what's happening in the background other than simply making this data available? If I flip back into Aleph, I want to show you a bit of the transformations that happen on top of the raw data that we bring in, right? Because it's not only about connecting to your ERP, you could probably do that in different ways. It's also about cleaning up the data and transforming it in ways that make it much more usable. And I want to highlight this. It's not a stochastic transformation, which is something that an LLM could be able to do. It's deterministic transformation. So what does that mean? It's not probabilistic. You get the same prompt and it means the same answer every time. It means the data transformations that happen in Aleph are basically not subject to hallucinations, right? So what are those data transformations? Well, first, we can do mappings. If I go into this tab here, I can show you a bit about how that works. But mappings are basically useful for different use cases. Maybe your management reporting wants to, you want it to look different than your chart of accounts in your ERP, right? So you can do something like this, where we basically map your chart of accounts to different management accounts to be able to report on those instead of the raw data comes in from the ERP. Or maybe you want to use this to clean up some data that comes in from the ERP, right? I guess you're all familiar with CRM data with messy or duplicate customer names, or ERP data with duplicate or messy vendor names. So all these mappings can allow you to have different subsidiaries, maybe of the same entity, consolidated into one, so that you're always doing planning and analysis on clean and consistent data, right? Not only are we doing mappings, we are also merging different data sets. So as we saw in the integrations tab, we can bring in data from the ERP, from your CRM, from multiple data sources that might be useful to do some of your forecasting and projections. And Aleph allows you to natively and again deterministically merge all of those data sets that might have disparate keys and not talk to each other if you simply drop them in a file, right? Finally, you can also do eliminations, allocations, reclassifications, any other sort of modification on the raw data that's relevant for your reporting, so that you can then pull it into any of the surfaces and are able to trust it, right? And finally, we have a checks feature that allow you to run conditional checks on all of your data sets and basically surface an alert whenever some of your data is not matching whatever you expect it to match or the conditions you expect it to match, right? So all this transformation layer allows you to have a data set that's clean, enhanced, that brings together all of your multiple sources, and that can act as sort of the finance data warehouse within the organization. And of course, this is much more finance specific than a generic data warehouse might be. So the finance team can rely on all this intermediate data layer to then layer on top of that your modeling, your AI, and all of your other workflows. As we just saw, you can always leverage all of your data in multiple connections within a single model. This starts to look a little bit like what Christian was just showing, where we have many different sheets feeding into this, and this is finally an output layer. And the interesting thing is, not only can you pull data from the warehouse into Excel, you can also push back from Excel into the warehouse, right? So let's say I have all of my forecasts being built here in this Excel spreadsheet. I can then very quickly flip back into Aleph and push those into one of these tables here, right? And this allows you to do intelligent versioning control, which would be tough to do if you had a standalone Excel model, right? By connecting it into our web app here, you can make sure to track who pushed what and what different versions you have live to make sure that you're always referencing the right data, the right version of the forecast, and are able to build this sort of more robust data layer that finance teams need. Finally, once you have all this into your Aleph instance, your actuals, your forecasts, and all this flowing seamlessly across scenarios, you can start to do more interesting things with AI, right? We all like how easy and how practical tools like ChatGPT or Claude are. So we are basically empowering those tools to access your data and, again, provide reliable answers you can trust based on this more robust source of truth, right? If I flip over here to our conversations interface, which is Aleph's own agent, you can see how you can start asking it questions about your data. It will surface the answers, and it will always link to the source of truth in either the table or the chart or the dashboard that's reflecting whatever that's acting as a source for whatever question you asked it, right? So you can always make sure that this is not hallucinating, and you can always trace it back to whatever the source is. Same conversations interface works in Claude, and you can also bring it into chat tools you might be using. So for example, you can ask, or you can tag the Aleph agent within your Slack instance, like I'm doing here, and again, it will answer the question, link to the source of truth, and then you can continue to dig deeper by asking follow-ups, which it will continue to surface answers for. So in closing, and to bring it back to the initial slide, Aleph is sort of that live connection with all of those data sources that you need to connect to all of your financial modeling. It then cleans up all of that data and transform it in ways that are deterministic, and then allows you to interact, pull, push it, and ask questions, or interact with it in natural language across all sorts of different surfaces. With that, I want to hand it over to Christian once again, in case you have any questions, and
yeah,
sure Q&A.
Yeah, so the two things that stood out to me there, why having AI built into a tool like Aleph is better than just using uploading your Excel to Claude directly or to any other AI tool, is two things. One, you mentioned the data cleaning aspect, right? Because with AI, it's all garbage in, garbage out. If you put a layer between your ERP, your HRS, your CRM, and you can make sure that the data is all cleaned, exceptions are handled, everything is neat, AI will do a lot better. And, your token usage also is a lot better. So it was a different question that came up. And the second thing is, trust, right? When you upload something to Claude, you never know, is it hallucinating or not? And you mentioned that it's not probabilistic when you use Aleph, but you don't even need to take that at face value, right? Because I saw that you allow people to just click on a link that AI gives you where you can check for yourself that what it told you is correct, because you can drill down to the actual numbers that you have connected with your ERP. We also got a question here in the chat. Jay asked, how do you ensure auditability? Do you want to expand on that? Because I think it's such a crucial piece of making that work.
Sure. So the way we ensure the auditability of all this is LLMs, or the agents, don't interact with the raw data itself. They interact at the calculation layer that Aleph exposes to those agents, right? So you can make sure that these agents are actually operating with data in ways that are consistent and supported by the platform. So let me give you a very quick example here, right? Once I have this report, right, which I just pulled, we can also do a pull and scan. Let me set some materiality thresholds, maybe 5% and $5,000. I can do pull. And what the AI will do here is basically pick all the rows where there's variance and surface the dimension that's helping explain that variance, right? So in this case, it's bonuses. So it's surfacing customer success as a department where these bonuses, where this difference is happening. If it were a different account, like software spend, it might surface the vendor dimension. But the interesting thing is, as you were saying, I don't really have to. Well, here we have an example, right? For advertising, it's surfacing vendors, right? It's telling me I underspent in Meta, Google Ads, and so on. But as you were saying, I don't really have to take this at face value. I can also pick these two numbers and do a drill down by vendor, and it will very quickly break all this spend down by vendor, and it will always be matching to the cent. How can we ensure that? Well, we do that by not allowing LLMs to probabilistically interact with the source level data, but actually have LLMs act with tools at their disposal at a calculation layer. So you can make sure that every interaction is always consistent and traceable.
Awesome. That also answers the question that KS raised. KS asked, in reality, have companies started trusting AI to be integrated directly to an ERP? And you just gave the answer, no, we don't just let AI loose with blanket access to your ERP. We have the calculation layers in between. And that's also, by the way, why it's very difficult to just vibe code this yourself, right? Because if you vibe code this with something like Cowork or Codex or something like that, or even OpenClaw, you kind of have to expose your data to the AI without these checks in between, right? And you really don't want to do that.
And listen, I'm very big on vibe coding. I do a ton of vibe coding myself. I think it's great for when you need something that's quick and dirty analysis. But the moment you need something that's production grade and repeatable every month in the exact same way, that you can also share across your company and have everyone access with the right permissions and so on. That's where I think production grade software like this actually has a huge gap with anything you could vibe code in a week under a week. Aleph handles that from the source. It makes sure that every user has access to the right tables and the right data. So your engineering head might be able to see engineering spend, but not customer success spend. And those permissions are then propagated across every surface. So AI will respond using only the data they have access to. They will only be able to pull the data they have access to in Excel, and works the exact same way across every surface. So again, when you start sharing and need a more multiplayer approach to these problems, that's when vibe coding usually becomes a challenge.
Sounds good. We have 1 minute left. I think I can quickly answer one more question that we have here. So someone asked, is anyone modeling in Sheets? And what is your experience / recommendation on Sheets versus Excel in the age of AI? So of course, when you look at which AI tools work best right now, Claude for Excel is great, right? It works really well. Gemini is a bit behind there when you look at what it can do in Sheets. It's not quite there, but I would say just wait a few months, right? I don't think you need to move out of Sheets into Excel just because Claude is a bit better than Gemini right now. Google is sitting on a lot of money, right? It has a cash printing machine with its advertising business, and they will catch up, right? I do expect that in a few years, or even just 6 to 12 months, those differences between the different tools will disappear. So definitely keep using Sheets if you're doing that. Fantastic. Sebastian, do you have anything you'd like to add before we wrap up?
No, this was a lot of fun. Thank you, Christian.
Sounds great. Yeah, thanks so much for having me, and thanks so much for all the good questions, and I'll see you for the next one.